You're not paying too much tax, you just don't have a strategy. I want to say something that might be a little uncomfortable. When business owners come to us and they're frustrated about the tax bill, and this happens all the time, the first thing we say is the tax isn't the problem, it's just the most visible symptom of the actual problem. And the actual problem is almost always the same. No strategy. Not that you don't have an accountant or that you don't have an advisor or that you don't have awareness. It's that you don't have a coordinated, forward-looking strategy that treats your corporate structure, your investments, your insurance, your personal income as one system instead of 4 separate things being managed by 4 separate people who rarely talk to each other. And that's what's costing you, right? It's not the tax rate. Hi, my name is Laurent Munier. I'm a partner and advisor here at Safe Pacific Financial. And in today's video, I'm going to talk about and reframe the way that most Canadian business owners think about tax. Because the frustration is real and valid. But if you're directing the frustration at the wrong problem, you're going to keep looking for solutions in the wrong places. And today's video is going to help fix that. Now, why does corporate investment income get punished so hard? We're going to start with something that generally surprises a lot of incorporated professionals when we explain it clearly for the first time. If you're earning money inside your corporation and then investing it, which sounds like the right thing to do, the Canadian tax system is actually designed to penalize you for it. Not aggressively or maliciously, but really systematically year after year. And here's how it works. When your corporation earns active business income, so this is revenue from your actual operations of your business of what you actually do. This is taxed generally at the small business rate if you're making less than $500,000 a year net. And that's somewhere, depending on your province, between 11 to 13% on those first $500,000. And that's the favorable rate. That's one of the advantages of being incorporated. But when you take that money, your profit, your after-tax income, and then you invest it, stocks, bonds, ETFs, GICs, real estate, other businesses, the income generated by those investments is treated differently. This is called passive income. So investment income earned inside a corporation is called passive income. And passive income is taxed at the highest corporate rate. This is often around 50% depending on your province. 50% on the income that your corporation already paid tax on once. So let me explain it in a moment why this system is set up this way and why it's not quite as punishing as it sounds at first. You know, like there's refund mechanisms in here, but the headline number is real and the psychological experience of this is real, and understanding why it exists is the first step to managing it. So the reason passive income is taxed so hard at the corporate level is this is what the government says. They said, well, you already got a tax advantage by earning the income in the corporation at the small business rate instead of paying personal tax at the full marginal rate. So if we let that money compound inside your corporation at the low tax rate, you would have an advantage over Canadians who earn and invest personally. And so this is where these passive income rules came in. And this is how the government sold it as we're doing this, right? These passive income rules are designed to prevent the corporation from becoming a permanent tax-sheltered savings vehicle. I might not agree with that, but fine, sure. That's what the policy rationale is. And whether you agree with it or not, the reality is this is what's happening. And here's like where it gets worse. So once your corporation's passive investment exceeds $50,000 a year, you start to lose your small business deduction, you know, that 11 to 13% that you're paying on your active business income. And then that grind down works like this. For every $1 of passive income that you earn over $50,000, you lose $5 of small business deduction. So what that means is when you are earning $150,000 of passive income per year, you lose your small business rate entirely on your active income. So now you're not just paying high tax on your investment returns, you're also going to pay a higher tax on your business income too. And again, depending on your province, your tax rate could double. Here in BC, that would be from like a 12% to a 27%, right? Going from small business rate to the general rate. And this is the passive income trap. And a lot of successful incorporated business owners walk straight into it without realizing it's happening until you get a bill from the CRA that says you owe us a lot of money. And so the misunderstanding around the 50% tax, we want to spend some time on this because this is the number that causes the most frustration. And I think it should. It also causes a lot of confusion. So when the business owners say that they're paying 50% tax, they're usually describing a real experience, but misidentifying how it's caused. And so let me explain kind of what's going on here. The Canadian tax system is built around a concept called integration. And so the idea with integration is that whether you earn the income personally or through a corporation, you should end up paying roughly the same amount of tax. And in theory, this means that the corporate tax and the personal tax on your dividend extractions is calibrated to approximate the tax that you would have paid if you just earned all the money personally in the first place. So this is the theory. In practice, integration is not perfect. So depending on the type of income, how it was earned, when you take it out, what province you live in, you could end up ahead or behind where pure integration would leave you. And there's the key point, right? The 50% tax that people feel and the sense of half of everything is going to the government usually isn't a single 50% hit. It's a series of smaller hits that add up. So you've got your corporate tax on your active income. Then you have your personal tax when you take the money out as a salary or dividend and you want to go to a restaurant or buy a pair of shoes. Then you potentially have passive income on what you've invested in the meantime, which is probably you're saving it for retirement. Then you have capital gains tax when you eventually sell the business, right? So none of these individual tax rates is 50% for most types of income. But when you stack them all together over time and you don't coordinate, the cumulative effect can be 50% and potentially more. So here's the important insight. Each of these individual hits has planning tools available to reduce or defer and sometimes eliminate completely, but only if you're using these tools intentionally and you're coordinating and it's part of a single strategy. So you've got the salary versus dividend planning implications. You've got the timing of when you pay yourself and when you take money out of the corporation, planning implications. You've got how do your corporate investments get structured, planning implication. And then how is your estate set up, right? For you to transfer this to the next generation, planning implications, right? None of these decisions exist in isolation. They all interact. And when they're managed independently by individual separate advisors who are not communicating with, you end up with a series of reasonable individual decisions that collectively would produce an unreasonable total tax outcome. And that's not the tax rates problem, that's coordinating your advisor's problem, right? That is one of the big issues. It's the lack of coordination between all these various advisors. And I want to talk about something that is, the most honest diagnosis of why successful incorporated Canadians overpay in tax. It's not because the rates are too high, although they are very, very, very high. It's not because the rules are unfair, although they are very, very frustrating. It's because that the people that are managing your tax outcome are not working together generally. And so let's describe how we see this come to us when you have a typical high-income Canadian, and how do they have their financial team structured? Usually there's an accountant. Accountant files the corporate returns, the personal returns, manages some compliance, handles your year end, and sometimes does tax planning around specific transactions. So the accountant is good at what they do, but most accountants are looking backwards at what happened last year, and then they're focused on the complying first and then the planning seconds, right? There's not a lot of accountants, and this is how you tell if you have a good one or not a good one. You want the accountants that are going to look forward, right? Obviously, they have to know what happened in backwards so that they can do your taxes, but you want the one who's going to tell you, if you keep doing this, this is what's going to happen next year. This is what's going to happen in 2 years. You planned to sell your house and buy something. This is what's going to happen when that happens, right? So you want the good accountants that are looking into the future and telling you what the future looks like, not just the ones that told you what happened in the past. There's also your financial advisor or your investment manager. So they're managing your investment portfolio. So they probably have your personal investments, and then maybe they're also managing your corporate account. Not all of them do corporate accounts, but they're usually focused on generating you some sort of return, having the correct asset allocation, maybe also managing your risk, and then product selection. So they're not typically thinking about how the portfolio structure interacts with all of these other pieces, especially your corporate tax piece or your estate plan. Then you'll have a lawyer. Maybe they set up the corporation originally, or they did your shareholders agreement. Maybe they've done a will or some estate documents for you. And then the lawyer comes up when there's a specific legal task, and then you pay them, and then they're out of the picture until something else happens. And then sometimes people have an insurance advisor. This is often somebody who sold them a life insurance policy at some point and checks in periodically. So you've got 4 different professionals, 4 different relationships, 4 different conversations. And between all of them, a significant amount of value is quietly just dripping away because nobody is sitting in the middle asking the question that actually matters. How do all of these decisions interact with each other across the full financial picture? Here's a simple example of what that coordination gap looks like in real life. So your accountant recommends paying yourself a combination of salary and dividends so that you can balance your personal tax situation. Totally fine, totally reasonable, normal. Investment advisor is investing the corporate retained earnings in a portfolio that's generating significant passive income annually, right? Totally fine, reasonable, but nobody's connected these two decisions to notice that the passive income from the corporate portfolio is taking away your small business deduction, which means that the tax efficiency of your salary and dividend structure is really being undermined by the investment strategy. And, the accountant is doing your dividends and salaries, whereas an investment advisor is doing your investments, and they're probably not talking. Both of them individually made sensible individual decisions, but together the decisions are producing a worse outcome than either of them intended. And this is the gap. It's not unique to just one client or to one situation. It's structural, right? It happens because the financial services industry is organized around products and specialties, and it's not integrated, and it's not integrated outcomes for the client. So the fix isn't really finding a better accountant or a better investment advisor. The fix is having somebody in the middle whose job is to look at the whole picture and make sure that all the pieces are working together. And then how do you lose a significant amount of wealth? By having the wrong structure, right? It's not just about the tax rates, it's about how do you set it up. And let me give you a couple of real numbers to make this concrete, because one of the reasons the coordination problem isn't addressed is because it's abstract. You can't just point to a line on the tax return and say, well, the coordination cost me $47,000 on that, right? It doesn't show up like that, but it does show up. And so here's a simplified example. So we'll take 2 incorporated people. They own a business, same income, same type of business, same province, same everything. The only difference is the coordination in the financial planning. So the first professional has a good accountant, a good investment advisor. They're doing the basics right. They're incorporated. They're investing the retained earnings. They got a decent portfolio. Tax planning is reactive, meaning it happens at year end based on what already happened. The other guy has the same starting point, but the financial structure is coordinated across the accountant, advisor, and insurance strategy. The corporate extraction is planned in advance. The investment income is managed relative to the passive income threshold, and the insurance is structured to create a capital dividend account. And then the estate plan is integrated with the whole thing. So over a 10-year period, same income, same investment returns, the difference in after-tax wealth between these two could be hundreds of thousands or millions of dollars. And not because the second guy found loopholes, or not because they did anything aggressive or played in the gray area. It's just because every decision they made was designed to work with every other decision they made instead of all of these things being made in isolation. And it's not hypothetical, right? This is a pattern that we consistently see when we review financial plans that were built without coordination versus ones that were built with it. The money doesn't just disappear. It slowly drains out consistently across dozens and dozens of small decisions over the years. And the frustrating part is that at the time, all of those little decisions were reasonable, right? The salary was set without modeling the interaction with your passive income. The investments were selected without considering the corporate tax treatment. The insurance was purchased for protection without leveraging it as a tax planning tool. The estate was structured without accounting for the eventual capital gains liability. And none of those are bad decisions, they're just incomplete. And the incomplete decisions over time become really, really expensive. So what are some things that actually close the gap, right? What does a coordinated strategy actually look like in practice? And so we're going to talk about 3 concepts. And these are going to be accessible because honestly, the technical complexity of all of these is really a distraction from what matters, which is understanding what do they do and why do they matter. So the first, corporate to personal extraction planning is what they call it in accounting, right? It's like, how do you pay yourself? This is how do you get money from your corporation into your pocket? When do you do that? What form do you do that? How, right? So most incorporated business owners have like a default that they do. So they pay themselves a salary, or they pay themselves dividend, or they pay some sort of combination of both. And this was probably set up years ago and probably not looked at or touched since. But the right answer to the question changes based on different factors. So what's your personal income level this year? What's the corporation income this year? What are your RRSP contribution limits this year? What's happening with your passive income this year? And does your income in retirement look different than it does now? What's that comparison? So you've got your salary versus dividends. This isn't a decision that you just make once. It's a decision that you should make every year based on whatever this year's circumstances are. And the range of outcomes, the differences between optimized extraction strategy and a default could be tens of thousands of dollars every year. And over your career, this compounds into significant money. This could be hundreds of thousands of dollars. So the goal of getting the money out of your corporation into your pocket is simple, right? Get the money out of the corporation and into your pocket at the right time and minimize the amount of total tax that you pay, both corporately and personally. Sounds simple, but really requires somebody who understands all of the variables and is actually modeling them every year. Now, the second one is called your capital dividend account and your RDTOH. And we're not going to get super technical in the weeds here, but inside the corporation, there are what the tax system calls notional accounts. So these are like invisible ledgers that track certain types of tax advantage accounts that your corporation has accumulated over time. So two of the most important ones is your CDA, your capital dividend account, and your RDTOH. You know, that's all you really need to know about this for this conversation. The CDA tracks amounts that your corporation can pay out to your shareholders tax-free, so that's probably you. These are tax-free dividends, not tax-deferred. They're totally tax-free. And the amount that flows into the CDA includes things like the non-taxable portion of a capital gain and life insurance proceeds that are received by your corporation above whatever that policy's adjusted cost basis is. The other one is your RDTOH. And this is a mechanism that allows your corporation to recover some of the high passive income tax that it paid. So when it pays out a taxable dividend to shareholders, this is essentially like a refund mechanism built into the system to prevent double taxation. Now, why do these matter? Because most incorporated business owners have no idea how much money is in either one of these accounts. And money that's sitting in your CDA can be distributed to you or to your shareholders right now, tax-free, if somebody's actually paying attention to it and telling you how much is in there and advising you to use it. And this is one of the most common coordination gaps. So the accountant knows about the CDA, but nobody's actively flagging when the balance is large enough to make like a meaningful distribution, or structuring the corporate activity to maximize these CDA credits over time. So it's not a tax rate problem like we talked about. This is an attention to detail problem and a coordination problem. And then the third concept is insurance as part of your tax architecture. And this is the one that surprises people because most businesses think of insurance as protection. This is something that you buy in case you die and then it takes care of your family. That's it, right? But a properly structured participating whole life insurance policy inside the corporation is also a tax planning tool when you do it right. And it's a significant one. So here's why. When your corporation owns a participating whole life policy and the insured person dies, that death benefit pays to the corporation. And any amount above the policy's adjusted cost base flows into what's called your capital dividend account or your CDA. And it creates the CDA credit that can then be distributed to the shareholders tax-free. So instead of retained earnings eventually being taxed as a dividend at 40% or more when they leave the corporation, they can go out through a CDA as a tax-free capital dividend to your shareholder beneficiaries, which for most of our clients would be like their family. So this is a huge difference on a large amount of corporate money. But the insurance doesn't only create value at death. While you're alive, that cash value inside the policy is growing tax-deferred inside this corporate structure. And that growth of the insurance policy does not count towards passive income, which means it does not take away your small business deduction the way that any other corporate investment portfolio does. So when you're building your wealth inside the corporation, it can grow efficiently. It doesn't trigger the passive income rules and it doesn't grind down your small business deduction. And then eventually it can all pass to your family tax-free through that CDA. So then it's not just insurance, right? It's part of your tax architecture. And it's one of the most powerful tools that's available if you're an incorporated Canadian business owner when you have a coordinated strategy, not just some product purchase, right? There's a lot of people that just want to sell you the insurance, but it actually needs to be coordinated with how you pay yourself, with your corporation, with your accountant, with the investments, with. It needs to be part of a bigger structure. So what does this coordinated strategy actually look like, especially when it's working all together? Because it helps to see the full picture rather than just these individual pieces. So let's talk about a dentist, an incorporated dentist, and she's been working for 15 years. She has a professional corporation, retained earnings are building up. She has a personal investment account. She has an RRSP. She has a TFSA, and she's been paying herself a combination of salary and dividends for years. And the split of salary versus dividend was set up when she first incorporated, and nobody's touched it since. She also has a corporate investment portfolio that's about $900,000 now, and is generating passive income of around $40,000 a year. She has a will, she has a basic corporate structure, she has a financial advisor managing the investment portfolio, and she has an accountant doing her tax returns. And so she feels like she's paying a lot of tax, and her accountant tells her that the numbers are normal for someone at her income level. And so she leaves the accountant's office frustrated, but she doesn't really know what to do about it. Familiar to a lot of people because this dentist is not the only client that has this problem. So here's what a coordinated review of this situation would say. So number one, the salary and dividend split hasn't been modeled against her current personal income situation in a bunch of years. So based on where her income is now, there's an opportunity to restructure this mix and save, potentially like $15,000 to $20,000 in combined personal and corporate tax every single year. Next, the corporate investment portfolio is getting really close to that $50,000 passive income threshold. And if it crosses that threshold without making any adjustments, she starts losing her small business deduction on the active business. So this could add probably like another $15,000 a year in additional corporate tax. Next, the CDA has a balance that nobody's talked about. Her accountant knows it's there, but nobody's advised her to declare a capital dividend. So she has $47,000 sitting in that account that could be distributed to her today, totally tax-free, with a simple form that the accountant would fill out and file with the CRA. Now, fourth, there's no insurance strategy inside the corporation. The retained earnings are growing. The estate tax liability at death is also growing, and it's going to be big. And there's no mechanism in place to fund that eventual tax liability that we know is coming without either her or her estate forced to liquidate, right? None of these issues require her to earn any additional income. None of them require risky investments or aggressive strategies or offshoring or all these things that, somebody on YouTube is going to try to sell you. All four of these things exist because the advisors in her life are just doing their own job well in silos, but they're not talking to each other and they're not connecting the dots for each other. So having a coordinated plan would address all of these four things and put significant money back into her pocket without her increasing her income in any way. So the extraction strategy of paying herself salary and dividend gets restructured and reviewed annually. The corporate portfolio is adjusted to keep your passive income below the threshold. You do that a little bit by redirecting part of the retained earnings into a participating whole life policy that builds this tax-deferred cash without triggering passive income rules. You've also got the CDA balance that she has. Take that out right away. Use the money, right? And then this insurance policy that we set up to deal with the passive income rules also creates a long-term estate tax funding mechanism, and it's growing CDA credit for the future distribution, right? So the total improvement in her financial position over like a 10-year period from these adjustments, again, without changing her income or her investment returns or her lifestyle in any way, it's a significant change. Conservatively, this is going to save her hundreds of thousands of dollars of real money that she can put straight into her pocket. Now, this is why you want to have a coordinated team or somebody coordinating your existing team. And The honest truth is really like, why doesn't this get fixed? Why doesn't everybody know about this? Why isn't everybody doing this? I don't know. And I'll be transparent. This is a problem that is very understood in the financial services industry, and this concept of coordinated planning is not new. And most sophisticated advisors know that the integration across your tax situation, your investment situation, your insurance, your estate, obviously will produce better outcomes. So why doesn't it happen? So there's a couple of reasons. So number one is the incentive structure. The accountants bill for their compliance work, their tax work. They're not typically compensated for proactive planning conversations. The financial advisors are based on the products that they manage. It's in their best interest to keep you invested. The insurance advisors are compensated on the premium, right? They don't get compensated for telling you about the corporate structure or for dealing with your accountant or your whatever. They just want to sell you the life insurance policy. And nobody in this traditional advisory structure is compensated specifically for coordinating all of these things. You don't get paid for the integration that ties everything together. You get paid for selling the individual pieces, but you don't get paid for putting them all together. So what happens? It doesn't get done, right? And it's not because any of these advisors is bad at their job. It's because the system isn't set up to reward the work that creates the most value. Another reason is that this coordination requires trust amongst all these advisors. The accountant needs to share information with the financial advisor. The financial advisor needs to understand your corporate structure that the lawyer set up. Your insurance strategy needs to be informed by the estate plan. So most clients haven't really explicitly authorized this kind of information sharing. And most advisors don't push for it because it adds massive complexity to their own workflows. So the information lives in all these silos and only really gets looked at sometimes. And the strategy is, how do you connect all these things? But who's getting paid for the strategy? The third thing is timing. Proactive planning conversations actually kind of happen reactively. So after you have a huge tax bill, you're like, how do I not pay this? Well, now it's too late. After some sort of major life event happens, or maybe a health event happens, or some big problem happens, then people try to fix it. But most of your options are gone when that happens. The damage has already been done, and now you're just scrambling. The best time to coordinate the strategy is before you need to, before the tax bill, before retirement, before the health event, before your estate, right? This is why we're making the video. I'm not criticizing accountants. I'm not criticizing investment advisor. They are all doing what they're supposed to do. But to give business owners a different way to think about the question, it's not, how do I reduce my taxes? It's, is my entire financial situation designed to work together in a way that minimizes how much money I'm giving to the CRA and to Ottawa now, when I retire, and when I die, or when I sell my business? If the answer is that yes, you're coordinated, great. You're probably in good shape and you're doing better than a lot of people. If the answer is, I'm not really sure anyone's actually asked me to coordinate all of this stuff across my whole picture, well, now this is a conversation worth having. And like I just said, you want to have this conversation before you need to have this conversation, because when you need to, your options are limited and they're often very much way more expensive than if you would have done it before you needed to. So who is this video for and who is this video not for? So before we wrap up, and we're getting to the end here, I want to be honest about who this kind of coordinated plan is even for. It's not for everyone. And you got to be clear about that up front rather than try to make people do a bunch of work that is not relevant. So if you're an early stage business owner, you're still growing, you're not generating significant profit or retained earnings, the priority right now is probably building the business, not optimizing the corporate structure around it. There will be a time for the conversation, but it's probably not today. If you do have time, you could start it. If you're a high income employee and you're not incorporated, you don't have a corporate structure, well, some of these things are just not available to you, right? There's still planning strategies that you should talk about, but the corporate specific ones that I've been talking about in this video are for incorporated people. And if you're a T4 employee, a lot of this is not for you. If you're an incorporated professional or you own a business, say you're a dentist, a physician, a lawyer, engineer, consultant, software, entrepreneur, and you've got retained earnings building up inside the corporation, and you've got an investment portfolio that's growing and generating passive income, and you've got an estate that's getting more complex as your wealth grows, well then yes, this video is directly relevant to your situation. And then the earlier that you have the conversation, the more options you have and the cheaper it is. Because what I've learned after doing this for like more than 15 years, clients who feel the most in control of their tax situations are never the ones that found a magic strategy or some product. They're the ones who at some point stop treating tax as an annual event and start treating it as a long-term thing, a long-term challenge that requires long-term coordinated response. And so the shift from reactive to proactive, from siloed advisors to coordinated advisors is what makes this happen. It's not your tax rate, it's not the investment product or the insurance product, it's not, your accountant, it's the strategy of putting all these things together. So now, some final thoughts to tie this all up, because today's video is getting a little long. Most Canadian business owners who feel like they're paying way too much in tax aren't wrong to be frustrated. But that frustration can be pointed at the tax rate, true, but it also could be fixed a little bit with a little bit of coordination. So instead of, looking at just the tax rate, you could look at your own personal structure, your corporate structure, your personal structure, and what you can control in your own world and what you can improve. The passive income trap is real, and it gets expensive real fast. And there's ways to manage it. The coordination gap between all of these people is real, and it's addressable. The extraction strategy of how to get money out of the corporation into your pocket can almost always be better optimized. Using your CDA, using your RDTOH, these are tools that most people are not using deliberately enough and not using often enough. The insurance structured properly inside the corporation isn't just insurance protection, it's part of the tax architecture. None of this is aggressive planning. None of this is a gray area. None of this is a loophole. All of this is built into the Canadian tax system, and it's designed to be used, and you probably should be using it if you're incorporated. But it only works when all of these things are coordinated and working together. When all of these things work together, when somebody's looking at the whole picture, when somebody's making sure all these individual decisions add up to a strategy, not just a series of reasonable choices that collectively produce an unreasonable result, this is what we do at Safe Pacific. I'm not your accountant. I'm not your lawyer. We work with your accountant. We work with your lawyer. And we're in the middle. We're making sure the strategy is connected. We want to make sure that we understand what is a coordinated review of your corporate, of your personal, of your financial picture. What does this actually look like? What's working? What's not? What's being left on the table? Where are you paying way too much? This is what we do, and this is what really makes us different from a lot of other financial advisors, especially people in the insurance space, is we actively want to be that person and to coordinate all these things. We get off on it. This is what we like to do. We look at the full financial structure. We'll run the numbers. We identify the gaps. We want to show you specifically what a coordinated strategy looks like in your situation. And this isn't generic advice, right? There's no product recommendations. We're not trying to sell you anything. We just really want to understand the picture and give a straight, honest look at whether your financial situation and your structure is working like it should. And if this is something that you haven't done or that you want to do, talk to us. You can book a time with us. Our first meeting is called a discovery meeting, where we really want to get to understand your current situation, your goals, your concerns. And the way to do that is you go to our website. It's safepacific.com. There's booking links all throughout the site where you can book straight into our calendar. You can send us a message through the contact page and somebody will get back to you and we'll set up a time. And then that first meeting is a discovery meeting where we just want to ask you a bunch of questions. If you're not ready to reach out, that's fine too. Keep watching. We've got hundreds of videos on YouTube that will help you get to a point where you're like, okay, we should probably do something about this now. We've got new content every week that's specifically for incorporated Canadian business owners and high income professionals that have a family in Canada. If you want to do that, go to the website, safepacific.com, book a time, send us a message, and then we'll take it from there. If you learned something today, if you got value from today's video, please do all the things that help the video spread to more high income incorporated professional Canadians like you, because you're very hard to find because there's not a lot of you. So do the things that the robots love, that the algorithm loves. Hit on the like button, hit on the subscribe button. If you have questions, leave them in the comment section. If you just want to yell at me, leave that in the comment section, because apparently social media algorithms really love rage right now. So rage on. I'm not going to take it personally. That's it for me. Thanks for watching, and I will see you in the next one.